Hey, welcome back guys. A very good afternoon, evening, morning to you. Okay, this video we're going to talk about pivot points or floor trader pivots or daily pivot. Plenty of different names for them, but all essentially the same thing. Now these are derived based on the floor trading guys back years ago in the pit who will try and frame the day based on the previous day's trade. Now we'll look at the formula in a second, and also then we'll look at some strategies, some setups, some probabilities as well, so we can kind of formulate something that maybe we can integrate into our trading plan, as well as kind of learn about these things. But really what I found interesting is that even we've talked about this in several videos before. If you've seen any more videos from me, if it's the first video, then welcome. But we've talked before about setting boundaries for yourself in your trading. In other words, you know, you've got such a universe of trades to be able to do, universe of strategies, universe of levels to play off. And even back then in the floor trading days, they would use the prior day's trade to give themselves a framework and a boundary to work off for today. Now the idea with pivot points is this, and we'll go into a lot more detail in a second, but let's have a summary. Let's get a drawing pen out and do a summary. So you generally have what's called the pivot point, and then you have, and that really is called a line in the sand. So in other words, when price is above it, it's considered that the buyers are in control. When price is below it, it's considered that the sellers are in control, roughly speaking. Then you've got what's called support 1 or S1 as it's marked on charts. Then you've got S2 or support 2 as it's marked on charts, and then vice versa to the upside, you've got resistance 1 and resistance 2. Now you also have resistance 3, 4, 5 or support 3, 4, 5, and you can go on, but generally speaking, S1 and S2 and R2 will keep price contained the majority of the time. Now I see there's a couple of examples here that we've gone out of it, but also to keep your charts clean, I always recommend just having, you know, S2, S1, pivot R1 and R2 on there. If price starts to go beyond it and you need more, you can add it more, you can add more in the settings, but to keep things clean, that's what I like to do. So let's have a look at the formula so we can work out exactly how it's calculated. And even though it seems like a little bit dull in like all the formula, you know, what importance does that have? It's interesting to me to see the weighting that is given to various price points in the previous day. So to get our pivot point, we have the previous day's high, the previous day's low, and the previous day's close divided by 3. So in other words, it's not the high and the low divided by 2 giving you the midpoint. It adds a little bit of weighting to the close. So you can see that if we close near to highs, the next day's pivot is going to be a little bit higher, because the sum of those three, the high, the low, the close, is going to be a higher value than if the close was nearer the low. So it's interesting to me that, and it makes a lot of sense, doesn't it? If you think about how important the close is, it's the point that everyone's looking at from a psychological perspective. Everyone's looking at it from a floor trading perspective. I suspect that it was when it was very important everyone had their orders done by. You know, there's just so many reasons why it makes a lot of sense. Interestingly, the open doesn't play a part at all in these pivots. Now, there are other ways to calculate pivots, and when I was doing some research for this video, I saw different types of ways of calculating it, and there are different labels on them, but this is the general kind of broad floor trader version that I think we can all use. If there's something else out there that you've got a good justification for using, by all means, you know, that makes perfect sense if there's a reason to do that. But this is the kind of normal one. If there's an official one, there isn't really an official one, of course, but it's the unofficial official one. If that makes sense. So let's look at R1. R1 is resistance 1, and it's today's pivot value. So we've already got that, and it's already been weighted for the range and the close, depending on where the close is within that range. To use that, multiply it by 2, then we take the low from yesterday, and that gives us R1, which is always above the price. It's the first level of supposed resistance, and that makes sense as well. If you think about the pivot, the pivot's been calculated based on the close. If it's been a trending day, it's going to be a little bit higher. So then we have the pivot, so that's our line in the sand where everything else is derived from, again using that weighted close price. And then we take the low from yesterday from that, and then that's giving us a level that's just that little bit high, because we're doubling the pivot value, then we're taking the low away. So it's giving some weighting to where the low was from yesterday. And the same with S1. identical formula, but we're taking it away from the high from yesterday, and that's going to be underneath the price. Well, not necessarily underneath the price. It does depend whether if the price gaps or not, but it's going to be to the downside or underneath the pivot, should I say. And then we've got R2, which is the pivot from today, plus R1 minus S1. So we've already got that R1 S1 kind of bracket based on double the pivot minus the low or minus the high, depending on where we are. And then we're just literally taking that and we're adding the difference, taking the pivot from today and adding the difference between those two. So you can see how, even though we can kind of get a bit ahead of ourselves and get ourselves a bit tied up in numbers and formulas, the important thing for me is to really see where the weighting occurs and to understand why that weighting is there. Obviously the close is important, and that's why it's weighted in the pivot, and then that obviously follows through to all the calculations, because the pivot is the base for the rest of the calculations. But let's put that to one side now, and let's look at, first of all, I want to eyeball some charts and just to show you the kind of theory behind it. And then in part 2 of this video, we're going to look at some strategies, some ideas for trade setups, and also some probabilities so we can frame our trades a little bit better. In other words, we can look to hold our trades a little bit longer if we know the probability of it tagging a level is quite high. We can maybe hold off the short if we're in an area where we're looking to get short, because we know that the likelihood of tagging this level is high. It opens up so many kind of avenues for us. But if you can just look at this, I've got a US dollar yen here, and by the way, obviously the guys in the pit were using it predominantly on the S&P 500 or the meets or anything like that were trading in the pit. But I think you can use it on pretty much anything. Now you've got to have there's a little caveat here, and a little bit of caution to be used when you're using it on currencies, because the closing price obviously depends on where you are trading it from in the world. The UK close is going to be different to the Asian close, the New York close. So you've got to be a little bit careful about using it in currencies, but I think you can use it in pretty much anything. So let's bring up a stock and let's have a look, like Facebook, for example. And the idea is it's framing the day. And if you can just eyeball this, you can see how many times we've kind of gone above R2 or S2. We have once yesterday, excuse me, and that was because the day before was a very narrow range, and obviously that makes sense. We've got a narrow range the day before. The pivot point, the R1 and S2 are going to be very, very narrow, so you're going to expand out. And also that makes sense from a logical perspective, because very often we get that, guys, we get a narrow range, and it's a very common setup and common strategy is to look for the narrowest range out of the last 7 days, and then the day after that you look for a breakout. Obviously not going to go into detail about that setup in this video, but it makes sense that that's also what the pivot is trying to show you. But the point is, if we just scan through here, we can see how many times R1 and R2 are tagged. Very, very often, very, very often indeed. S1 and S2, very unlikely that we break out of it. And when I say unlikely, it happens, of course it does, but when you look at the number of times it happens, it's not so much. So anyway, stay tuned for the next video. I want to talk about some strategy ideas that we can use. Perhaps we can use them as a standalone or integrate them with our own existing strategies, probabilities, and really just try and use these to our advantage. Rather than understanding what they are, let's see if we can use them to our advantage to make some better trades out of them. Anyway, if you like this video, guys, give it a thumbs up, please, and don't forget to subscribe. If you've got a comment, stick it in the box below. You know the drill. I will read it, good and bad, and we have some actual videos where we'll talk about some questions or some comments that you have left. So if you've got something you'd like to say, stick it in the box below. See you at the next one.